We are on to the third main investment option that people utilize to accomplish their financial goals, and that is mutual funds. Chapter 9 in our book, Next Gen Dollars and Cents, contains a much more in-depth discussion about mutual funds. The purpose of these videos and all of our chapter videos that mirror the chapters in our book, Next Gen Dollars and Cents, sort of meant to provide a summary overview of each topic that our book covers in much more detail on a chapter-by-chapter basis. So mutual funds are basically professionally managed investment vehicles that pool money from multiple investors and consist of diversified portfolios of stocks, bonds, or other securities. In English, with a mutual fund, effectively you own various companies in multiple industries that produce a cross-section of the goods, products, and services that you and I and the rest of the world use on a daily basis. So basically a mutual fund, a pooled investment that invests in a variety of different companies. The value of a particular mutual fund individual share is determined by the net asset value per share. Now, this is calculated daily based on the total value of the fund's assets minus its liabilities divided by the total number of outstanding shares. And so that share price of a mutual fund is typically calculated once per day after the market closes and the price of its underlying holdings have been determined. So chapter 9 of our book, Next Gen Dollars and Cents, discusses a lot of the features of mutual funds, their numerous classification types, their expenses, and of course the general pros and cons of owning them, and ultimately how to analyze their performance in your portfolio. So let's begin our overview of these various topics. So mutual funds themselves offer investors a variety of convenient, easy-to-use features, whether it's setting up a systematic withdrawal plan that sends the same amount of money every month to your bank account if you're retired, to allowing you to accumulate effectively through a systematic investment plan that allows you to put a certain amount of money into a particular fund on a regular basis. Ultimately, what mutual funds provide investors is broad diversification without a significant outlay of money. Account minimums can often be as low as $250. And with that, once you are able to own a share of a particular fund or even a fractional share of a mutual fund, then ultimately you get that fullest amount of diversification on a proportionate basis that exists inside that fund. So several different factors by which mutual funds are classified, including sort of types of investment holdings, company size, location, investment management style, sector, target date. All of those are sort of different ways in which funds can all be classified. So we'll start with some of those different classification types and sort of start with the broadest first. There are three general classifications for funds based on the type of holdings that they own, right? So a stock fund is obviously going to own and invest predominantly in stocks. A bond fund is going to invest predominantly in bonds. Of course, for more information on what stocks and bonds are as investment choices, make sure you check out some of our prior videos, particularly those on Chapter 7 and Chapter 8 of our book, Next Gen Dollars and Cents, which have a much more detailed discussion of stocks and bonds, respectively. Balanced funds typically are funds that invest in a mix of stocks and bonds, maybe 60% stock, 40% bonds. Those are the three sort of most general ways to classify or categorize a particular fund. You can also categorize funds based on company size. You can have funds that focus on predominantly large companies, which are companies that have market capitalization exceeding 10 billion, mid-sized companies, or smaller company-sized types of funds. So certainly based on size of company. You can also have funds that are categorized based on location, sort of where the underlying holdings of that fund are located. A domestic fund, for example, is going to own companies that are based in that investor's home country. A global fund is going to have companies from all over the world, the home country and foreign countries. And then international funds are going to be focused solely on companies that are outside the home country of that investor. So those would be typically just companies that were located in or listed in foreign markets. So that's another way to classify it. You can also classify funds. So as you're getting the picture, there's a host of ways in which to classify funds. You can also classify funds based upon investment management style. So here we have active versus passive management, two distinct investing strategies that can be applied to mutual funds. With active management, fund managers sort of leverage research and analysis to make active investment decisions inside with respect to the individual holdings of a particular fund. Conversely, passive management tracks sort of a market index, just really aiming to mirror that particular performance. Accordingly, a passive index fund will always underperform, unfortunately, and never outperform its respective index, because all funds, even index funds and passive funds, have internal expenses, which we'll talk a little bit more about later on in this video. So, at the end of the day, to just talk about that active versus passive distinction between how you might categorize a particular fund, you do have to be very careful in terms of what investment management style is used by the funds that you own. So oftentimes active funds can be relatively expensive or don't have particularly good performance, particularly those that don't have a really long established track record. And in that case, if that's all you're looking at, then certainly a passive or an index fund might be a better investment choice. At Nelson Financial Planning, we believe that separating out good active funds from sort of the universe is possible by using well-established screening tools that look at track record and the team orientation approach that a particular fund uses. So using that well-established, actively managed funds, ultimately you can generate superior results over time with sort of less overall risk as well, which isn't something that necessarily gets talked about a whole lot of late, but there is clearly risk in any type of fund that you own, whether it's active or passive. And today, given sort of the narrowness of the market, where you've had a very small handful of companies that have been driving these market indexes, you may find that passive funds, in fact, have a little bit more risk or a little bit more concentration, less diversification than what you might realize. Another good way to classify funds as well is whether they are looking at the underlying company's investment management. A company with a growth approach focuses on reinvesting the corporate earnings for the future, whereby a value or dividend-paying approach would be a company that is paying out dividends or seeking to maximize current revenue streams. Mutual funds can also be sector-oriented, where they're focusing on a specific industry or portion of the economy, such as, say, technology or healthcare or energy. And then lastly is target date funds, which sort of automatically adjust their underlying holdings or underlying asset allocation over time to the particular year that is attributable to that fund. Often that is intended to represent sort of that individual's targeted retirement year. These funds are omnipresent, and particularly in employer-sponsored plans, where the goal is to sort of simplify that asset allocation decision that people need to make. Unfortunately, if you simplify that decision, it doesn't necessarily produce quality results, as these funds typically underperform the market, often get too conservative too early in sort of the grand scheme of things. So that's sort of some of the main ways to classify funds based upon a host of different factors. At the end of the day, when we we think about mutual funds, there is an expense internal in them, and that expense of a particular fund is represented through its expense ratio, which basically represents the annual fees that are happening internally to cover the ongoing costs of that fund on a regular basis. Obviously, the lower the expense ratio, the more of the fund's returns you get to keep, which ultimately boosts your overall investment return. So to calculate the expense ratio, you got to look at the fund's total expense, divide that by the full value of its constituent holdings. Several factors obviously contribute to a mutual fund's expense ratio. You've got the internal management fees by the provider or the investment manager of that particular fund. And then, of course, ongoing operating costs, administrative, legal, accounting expenses. What we see is that expense ratios can certainly vary significantly by a particular fund. So make sure you spend some time looking through that part of Chapter 9 of our book, Next Gen Dollars and Cents, because it does contain a variety of tips, if you will, to help you select funds looking at the expense side of things. And one of the tips is to sort of look at comparable funds, large company funds to large company funds and the like, so that you can look at different, compare those expense ratios across those different types, those different funds that are of the same type. Another important tip to realize when you're looking at expenses of a particular fund is to look at the historical performance. Mutual fund performance is quoted net of expenses. So when you look at a fund that might have a little bit higher expenses, but if it's got a better track record than something that might have lower expenses, well, then the reality is the net performance always is the most important factor when selecting a fund. So you certainly want to also factor in other costs as well. Oftentimes those other costs could be sales charges, transaction charge, and professional fees as well. So if you're working with a financial professional, often their fee may be in addition to any investment expense that is part of your underlying investments, or it can be sort of bundled together. That's sort of the approach that we use at Nelson Financial Planning, is to have that bundled all together inside that mutual fund expense ratio. Bottom line, take the time to really understand your expenses and the financial professional fees that you are paying. Sadly, we regularly see where these financial professional fees are often approaching 2% or more, and that can be a significant drag on the underlying performance of your investment. So make sure that you're really taking the time to understand exactly what those underlying expenses and professional fees are when you're using mutual funds. Just like any other investment, right? Mutual funds or owning mutual funds has a variety of sort of positives and negatives associated with them. Some of the pros, if you will, of owning mutual funds is they provide diversification for smaller dollar amounts. They also have a lot of flexibility in terms of their ease of use. Some of the negatives or cons of owning a mutual fund would be that you need to really understand kind of what those fees are, particularly on newer funds. Funds that have been around a longer time often will have much lower expenses than a fund that's only been around for 3 or 4 years. Similarly, one of the cons, if you will, of a fund is that as an investor, you don't have direct control over what the underlying holdings are of a particular fund, whether it's an active or a passive fund. All of those are going to be determined by the underlying investment management company who is sort of the manager of that fund itself. So at Nelson Financial Planning, we certainly believe that you can correctly screen for actively managed funds with consistent long-term investment results. And that's certainly an ideal option for a well-diversified, better performing, and highly flexible investment plan. In doing so, one of the ways in which we do so, and the book talks about this, is we actually run a Morningstar analysis when we review client accounts and portfolios. And what that Morningstar analysis does is it really allows us to look at performance, risk, expenses, and diversification. Chapter 9 of our book, Next Gen Dollars and Cents, actually contains a free offer to run such a Morningstar analysis for your portfolio. So if you're interested in that and to learn more about mutual funds in general, make sure you check out Chapter 9 of our book, Next Gen Dollars and Cents. You can get a free copy of our book by texting free copy to 407-791-0070. That's 407-791-0070. My name is Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning, and author of Next Gen Dollars and Cents. Thanks for watching this video.